What is going on, everybody? TG here. We are back with another video. I thought I would break down and talk to you guys about the risks of investing in China, why I personally am investing in China, and I think that these risks are worth taking, and how you can as well. I'm going to be going over a lot of this today in this video, talking about everything from CCP and geopolitical control, VIE structures, and so much more that is involved with China and China's stocks, especially stocks listed here in the US, potential delistings. We're going to go over everything and more, including why some massive hedge funds have been buying on the dip. All that I ask in return is that you guys can hit that like and subscribe button. It means a ton to me. But let's just jump right into this video. Some of the biggest names in China, such as Alibaba, Tencent, and Didi, have all been under huge scrutiny this year as China has clamped down on tech stocks, especially stocks listed here in the United States. It has been an awful couple months for Chinese tech stocks as President Xi's crackdown and regulation has continued to batter these stocks into the ground. A lot of people are thinking that the bottom is in, and a lot of people are believing now might be the best time to invest into these Chinese stocks that have been hit so hard by the regulatory clampdown. Now, we really started seeing a lot of this crackdown almost a year ago today, because almost a year ago today was the suspension of Ant Group's massive $37 billion IPO. And if you look at the timeline of this and compare it directly to Alibaba's stock price, and if you guys know, Alibaba owns 33% of Ant Group Financial, it is very, very interesting. First off, looking at it, September 14th, when all of this started, China issues new rules for financial holding firms. About a month later, Ant gets the green light to IPO. Good stuff, right? They're going to IPO, everything's looking good. They're getting the backing of huge strategic investors, and they have a bids of over $3 trillion for their shares. You look at Alibaba's stock price on October 26th and October 27th, shares are sitting at all-time highs, about $317 to $319 a share. And then here's where things get bad. A couple days later, Beijing flags concerns over fintech. And this is when Jack Ma spoke out against the banking industry and the financial sector, and basically raised the eyebrows of President Xi. November 2nd, regulators announced talks with Ant Financial, including Jack Ma and other executives. And then November 3rd, Shanghai suspends Alibaba's IPO. And if you look at Alibaba's stock price, what happened with this? In that little less than a month period, the stock fell almost 20%. Because this is huge. This is over 33% of Ant is owned by Alibaba. It's a huge chunk of their revenue. And so not only are they not getting that money from their IPO, but the company is drastically changing on what they're doing. They have to fix a lot of their things, and it's going to cost them a lot of money by changing up their lending program. And then a couple months later, Alibaba got hit with the biggest fine of all time, $2.8 billion for antitrust practices. Again, sending Alibaba shares spiraling farther and farther down. This is why it is a risk to invest in China, because things like this can happen. The CCP can come out at any time and announce huge regulatory crackdown, and stocks can get hammered extremely hard. If we look at the overall shares of the China ETF, things were actually looking pretty good in February. They were at all-time highs. The Chinese Internet Shares ETF was sitting at about $104, $105 a share. Since then, it has declined 50%, literally cut in half, because of these regulatory and tech crackdowns on stocks.
We've got some real financial horror stories out of China, although admittedly they pale in comparison to the human rights horror stories. You got cases of blatant fraud like a Luckin Coffee. That people braided me from that one for spotting that. And that came public in 2019. The stock tripled from its IPO price before we found out that Luckin was faking a big chunk of its sales, and the shares imploded. Within 13 months of coming public, the stock got delisted from the NASDAQ. You've got shady companies with disclosure issues like Phoenix Tree Holdings. That's a Chinese real estate company that raised over $100 million in January of last year. The stock steadily worked its way lower, and a few months ago it got delisted from the New York Stock Exchange for failing to, quote, make timely, adequate, and accurate disclosures of information to its shareholders and the investing public, end quote. Or how about RLX Technology? Now, this is a vaping play that's been the largest Chinese IPO of 2021, the largest. So what happened here? RLX surged from $12 to $35 in its first couple days of trading. But since then, the stock has plunged to the single digits as the Communist Party has started cracking down on vaping. Boy, they were smart to get that deal done, huh? Now, the company's being sued by investors for allegedly overstating its financials and misrepresenting the risks when it came public. However, that doesn't mean you should give up on every single Chinese IPO. While a lot of them are indeed low quality, there's a big caveat. The larger ones, they tend to be much, much better than the smaller ones. Doesn't make them a sure thing, but it means they're sometimes worth buying on a case-by-case basis, which brings me to the one I want you in on. Didi, D-I-D-I. That's the Chinese version of Uber that's coming public on Wednesday. This company has a stranglehold on China. The ride-sharing market, they own it. They crushed their competitors and then bought them up when they got tired of losing money. That includes Uber China. Didi's also got some really huge backers. Chinese tech giants like Alibaba and Tencent, a Japanese conglomerate like SoftBank, even Apple is in Didi. Finally, based on the proposed price range, which values Didi at around $65 billion, I think the valuation seems eminently reasonable. Now, there are some antitrust concerns here, but as long as they stay on the Communist Party's good side, and I know it's probably hard to do, but as long as they do, I doubt they'll have much trouble with the regulators. So if you want to speculate on a Chinese IPO, you've got my blessing to bet on Didi. I would try to get as many shares as you can.
So what ended up happening to Didi? Well, initially, amazing. Stock soared at its IPO price over 25%, hitting $18 a share, and then things got bad quick. The stock dove hard after more crackdown and regulation, and it was a continuous bloodbath, and shares are now currently sitting at exactly $9 a share, which is exactly 50% from highs. And they were much lower at one point. This stock was sitting at about $7 a share. The lowest it hit was $7.16 this year. If you guys want to read more about it, you can read all on here. I'll link that in the description below. But it was a massive, massive crash that Didi had. And like again, the stock's still sitting down 50% from highs after China came out and absolutely demolished it. So now let's talk about one of the most confusing and interesting structures that allows us foreign investors to invest into these Chinese companies called VIE structures. Essentially, when we are buying shares in a company like Alibaba listed here in the US or Alibaba listed in Hong Kong, we are not actually buying shares of the company. We are buying shares of a holding company in the Cayman Islands. Now, let me slow that down a little bit and let me show you guys what that essentially looks like on a chart. So, foreign investors, this is us. These are PRC individuals, People's Republic of China. We are all trying to invest into a company. So, let's use Alibaba for example. Alibaba is a Cayman listed company offshores in the Cayman Islands. So, it essentially looks a little bit more like this. We are allowed to invest into the Cayman Island holding, but we do not have the same rights as regular shareholders. Now, shareholders in the US, when we buy shares of Apple or Microsoft or any of that, we have voting rights. We are allowed to vote on things as shareholders. The VIE structure works a little bit different. Owners of Alibaba's American shares will have no control. Basically, we have no say in the voting, no say on the management. Furthermore, we own company in a very limited sense. We are entitled to the profits of the company. That's part of the arrangement. So if Alibaba is making profits and the share price goes up, we are making profits in that. But we do not have the ability to vote on certain things, vote out management, vote on things that regular shareholders would. We essentially are just entitled to the profits. So if you notice when we're buying shares of Alibaba, that is why it says this holding group, because it's not actually Alibaba shares. It's not like when we go here, we're buying Carnival Cruise, and by owning a lot of Carnival Cruise shares, if we own a certain amount, we can vote on things like board members, management, company reconstruction, all that stuff. We cannot do that with Alibaba. But this allows us to be able to invest in foreign companies. So this variable interest entity allows for that and allows for us foreign investors to have part of the profits of Alibaba. So obviously there's a big risk in this because we're not technically owning any of the shares. delisting can be an issue, especially after the new bill passed. And this bill was initially signed last December by President Trump, called the Holding Foreign Companies Accountable Act, which prohibits foreign companies from listing their securities on any U.S. exchange if the company has failed to comply with the PCAOB audits for 3 years in a row. Now, the reason why this is huge and why this is the one thing I'm a little bit worried about investing in Chinese companies in the future is because currently the Chinese Communist government refuses to allow the PCAOB to inspect audits of companies registered in China and Hong Kong. So, essentially, as of right now, they are not letting American auditors look over these Chinese companies' balance sheets, their earnings, all that. They are not allowed to overlook that. Based on this act, if for 3 consecutive years they don't, they will be delisted. They will be removed from the New York Stock Exchange. Now, you could obviously buy shares into the Hong Kong one, which is this one, but this one right here, Alibaba, BABA, would be delisted. Now, the reason this is such a big issue is because, yeah, you still can get access to the shares. You're not going to lose all your money, but the stock would take a big hit, in my opinion. A lot of money that would be used in, American investments and funds and ETFs and all that would be gone. They would be forced to sell, and it would cause a massive share price crash. I don't think this is going to be too much of an issue. It is a couple years down the road, and I do think there's going to be some cooperation on both sides, but the risk is there. We cannot deny that. This bill is a big issue because if for some reason the Chinese Communist government does not want to cooperate at all, then these stocks are going to be delisted, and that's billions and billions and billions of dollars of American investing money wiped out, essentially. That's going to cause a stock crash. Yes, you can still own shares in 9988, which is the Hong Kong listed VIE of Alibaba, but there's no doubt that the stock would take a very, very hefty hit. So that's probably the biggest issue right now, biggest risk is this VIE structure and the potential delisting because of this Holding Foreign Companies Accountable Act. So again, this is a little bit down the road, but I definitely think that it's worth talking about, and I definitely think that it's worth acknowledging the risk because you want to be able to make sure you know what you're buying and you know the risks involved in that. I hope, for my sake, for if you guys are watching this and you're invested in it, your sake, that they cooperate with the PCAOB and the auditing and everything goes smoothly and these companies can survive and thrive listed here in the United States. But again, we're talking about the risks. We're talking about all of that. So just thought I'd bring that up. Now, one thing we can't not talk about is some of the big funds that have been dumping Alibaba and other Chinese stocks, such as BlackRock that sold over $117 billion, which is about 90% of their stake last quarter, and such as ARK that has been dumping almost all of their Chinese stocks to completely zero shares as of last Friday, dumping all of their Baidu, all of their Alibaba, and all of their Tencent holdings, and now holding 0 shares of the stock. Obviously, a lot of people are betting that it is uninvestable to invest in China. They are believing that it is no longer worth holding any shares of companies in China or anything that has to deal with China. But there are others that are contrarians and betting big on it. People like Harbury and Charlie Munger, who have been buying actually a lot of Alibaba stock recently. Charlie Munger disclosed a massive, about $38 million position, and Monish as well, buying tons of Alibaba in Q2 and Q1 of this year, making up again over $50 million worth of Alibaba. While some people are looking at China and seeing something uninvestable, people like ARK that are trying to sell at the bottom, there are people that are being contrarians and buying the dip, buying when everyone else is fearful, buying when others are scared. And I think that's going to be a great opportunity, and that's why I'm doing the same as well. I believe that this is a great time to buy into Chinese companies that have been just massively beat down, companies that are down, 50% from highs, great solid companies, Baidu, Tencent, Baba. These stocks have all been absolutely obliterated. And I think that this could be an amazing, amazing opportunity for those who are patient and those who can see opportunity when everyone else sees fear. I leave you guys with this. Do the research on your own. Dig into these companies, dig into these companies' financials, and look and make that decision for yourself. For me, I believe it is a great opportunity to own Alibaba, to own Baidu, to own a lot of these companies. I see this, and I know a lot of people are scared by seeing, these huge, huge red numbers. But I also see it as an amazing opportunity. I see it as an opportunity to be greedy when others are fearful. When everyone else is selling, just like what happened in the COVID crash of 2020, when everyone was selling these companies and thinking that it was the end of the world, the end of this, there was a couple people that bought the dip and a couple people that made a fortune. I am taking a big loss right now, and I understand that. But I do believe that down the road, with patience, this will be a good play. Guys, let me know your thoughts on all this. I know this is a long, hefty video. I know I covered a lot of topics here, but I ask that you guys remember to hit that subscribe button. If you want to talk to me, come in the Discord. I'd love to chat with you guys. It's in the link in the description below, and it's totally free. Would love to chat with you guys. But anyways, guys, enjoy your day. Have a wonderful day. This video took me a long time to make, so if you guys hit that subscribe button and like, I'd appreciate it a lot. But anyways, guys, have a wonderful day. I'll see you in the next video. Bye.